Okay, let's dive right into this explainer. Today, we are unpacking a truly fascinating corporate story. We're looking at the anatomy of an acquisition. Specifically, we're exploring how a perfect storm of macroeconomics, shifting consumer behavior, and, well, some really heavy debt forced a historic manufacturing stalwart into an opportunistic buyout. If you want to understand how broader economic forces can bring even the most established giants to the negotiating table, you are absolutely in the right place. To really appreciate the gravity of this situation, we've got to start with this number, 143. Leggett Platt is a 143-year-old Missouri-based manufacturing giant, founded all the way back in 1883. For its first 50 years, the company literally made a single product, the spiral steel coil bed spring. Right? So they aren't some flashy fly-by-night startup. They're a legacy infrastructure company, deeply embedded in the products you probably use every single day. And this brilliantly illustrates their footprint. Looking at their recent revenue splits, they're actually quite diversified. You've got 34% of their business in furniture, flooring, and textiles, and another 28% in specialized products. Think things like automotive seat comfort systems. But look at that largest slice, 38% in bedding products. They are global leaders in inner springs, specialty foam, you name it. But as we're about to see, that heavy reliance on bedding, it made them incredibly vulnerable to shifts in the housing markets. Which begs the obvious question. How does a century-old, deeply entrenched industry giant find itself completely cornered by a frozen housing market? Well, there's a fundamental tension here between Leggett's long-standing business model and a sudden, severe structural economic slump. Let's look at the exact catalyst. Here is the macroeconomic reality that hit them like a freight train. In 2025, U.S. home moves hit a 48-year low. Why does this matter to Leggett & Platt? Because bedding volume is directly tied to housing market turnover. Think about it. People generally don't go out and buy a brand new mattress unless they're moving into a new home. This wasn't just a mild cyclical dip. This was a massive structural headwind. People simply stopped moving, which completely choked off the demand for new mattresses. And the cascading effects of that housing freeze were severe. Leggett sustained some really heavy structural damage. As mattress demand just plummeted, they had to make drastic cuts to protect their margins, ultimately announcing a restructuring that slashed their bedding footprint from 50 facilities down to just 30 to 35. At the exact same time, they were getting squeezed on the other end by higher costs for chemicals, energy, and, of course, global shipping disruptions. I mean, they were literally caught in a vice. So the macroeconomic headwinds were brutal, but let's transition and see how this actually translated into hard, unavoidable financial damage by the first quarter of 2026. Now, what's really interesting about this is the sheer velocity of the decline. If you look at Q1 2026 compared to the same period a year earlier, revenue dropped by 10.2%, falling from over $1 billion down to $918.2 million. But look at the bottom line. Diluted earnings per share took a massive 36.4% plunge, dropping to just 14 cents. Net income fell from over 30 million to 20 million. You can practically hear the clock ticking down on their independence. But earnings only tell part of the story. For any established manufacturer, cash is oxygen. And their operating cash flows swung violently from a positive $6.8 million in Q1 2025 to a steeply negative $56.1 million in Q1 2026. This reflects a larger use of working capital and those lower earnings we just talked about. It's a critical, glaring warning sign. And falling earnings and negative cash flow become incredibly dangerous when you have a massive $1.5 billion in long-term debt hanging over your head. This situation triggered a serious response from Wall Street. S&P Global Ratings stepped in, and while they affirmed the company's BBB- rating, they officially assigned them a negative outlook. Why? Well, because Leggett's debt leverage, their net debt compared to their adjusted EBITDA, had ballooned to 2.8 times. For context, their long-term target was 2.0 times. They were heavily over-leveraged for the environment they were operating in, leaving them virtually zero room for error. To quote S&P directly here, Leggett has limited cushion to absorb higher-than-expected costs or further deterioration in mattress demand. That is a chilling assessment for a legacy company. This perfect storm of a heavy debt burden, falling consumer demand, and margin pressures meant Leggett & Platt was officially running out of independent options. Which brings us to the climax of our explainer. In April 2026, Leggett & Platt entered into an all-stock merger agreement to be acquired by Somnigroup International, who, tellingly, was already their largest customer, representing roughly 7% of their total sales. Let's move to the M&A analysis and see how this builds. Somnigroup didn't just buy a struggling company. They capitalized on Leggett's vulnerability to snap up their incredible, deeply entrenched engineering capabilities and, crucially, their underlying cash generation potential for when the market eventually normalizes. Somnigroup's CEO Scott Thompson laid out the motive crystal clear, saying, Leggett Platt's engineering capabilities, diversified end users, and cash-generating financial profile meaningfully enhance our global platform. So while Leggett was undeniably distressed, Somnigroup saw right through the immediate macro headwinds. They saw a highly valuable 143-year-old infrastructure that they could seamlessly integrate and leverage within their own massive platform. So the big question for retail investors, is the price actually right? Considering the deep distress the company was in, did the shareholders actually get a fair deal in this buyout? To answer that, we first need to look at what the market thought the company was worth independently, right before the deal. Wall Street analyst consensus had a price target of $10.25 per share. There were pessimistic targets as low as $9 and optimistic highs of $12, but that $10.25 mark sets a firm baseline for what the market thought they were worth. But let's take it a step further. If we look directly at an independent discounted cash flow, or DCF model from the University of Reading, things get really interesting. When you strip away the immediate market panic, that short-term housing freeze, and look at the projected cash flows over the long term, the true intrinsic fair value actually sits at $11.98 per share. So the crucial point is verifying the math behind that 11.98 number. Are they overinflating it? Looking at the assumptions, we see a 9.1% discount rate to account for risk, a very conservative 1.5% long-term terminal growth rate, and a standard exit multiple of 5.3 times EV to EBITDA. These are highly realistic, standard assumptions for a mature manufacturing business. The math is definitely sound. Which brings us to the final valuation contrast. Somnigroup's implied offer price was $11.36 per share. That $11.36 offer is a healthy premium over the Wall Street consensus of $10.25. It gave shareholders immediate upside. However, it still falls slightly below that independent intrinsic value of $11.98. And that leaves us with a fascinating final thought to ponder. Did Somnigroup use their leverage as the biggest customer to score a once-in-a-generation bargain on a 143-year-old American manufacturer? Or, given the crippling debt, the negative cash flow, and a housing market completely frozen in time, was this 11.36 offer simply the best possible escape hatch for a cornered giant? It really forces you to weigh long-term intrinsic value against dire, immediate macroeconomic reality. Keep this dynamic in mind the next time you see a legacy company struggling in a shifting economy. Thanks for joining me on this explainer, and I'll catch you on the next one.